Okay, what's good, y'all? It's your boy Tibby back with another one. Welcome to episode 2 of this day trading 101 bootcamp, where we're going to go over the markets, instruments, and the time frames. So yeah, let's just get into it. These videos are going to be pretty quick. I'm trying to keep them pretty short and save more time for whenever we're doing more examples and like hands-on things. So I'm just going to run through like more of the foundational information. You guys can always go back and like take more notes and, dive a little bit deeper if you need to. But yeah, let's just get into it. All right, so let's talk about the different types of trading that there are. So we have scalping, intraday trading, swing trading, and position trading. What I like to focus on is intraday trading. That's what you're going to see right here is the second one, but I'm going to go through all of them just so you guys can kind of see the different trading styles, and you could probably find something that fits more of your lifestyle and the type of trader and your personality. So yeah, let's just get into it. So the first one is going to be scalping. It is very short-term trading style focused on making multiple quick trades within seconds to minutes to capture small price movements. The time frame is seconds to a few minutes. The pros with scalping, you're going to have a high frequency of trades, which means more trade opportunities, less exposure to market moving news, tight stop losses, and quick feedback. So pretty much you'll know if you're right or wrong pretty quickly whenever you're scalp trading. The cons, it's going to require large laser focus and fast execution. High transaction costs with the spreads and commissions is mentally and physically exhausting. This style of trading is best for traders who can sit and watch charts for hours, quick decision makers with strong discipline, and those with access to low latency execution and tight spreads. It's often like prop traders and people who have advanced setups, but we don't focus too much on that. So the next one is intraday trading. Like I said, is day trading. You're buying and selling within the same trading day. No positions held overnight. Minutes to hours is what the time frame is going to be for day trading, and all trades are closed by the end of the day. The pros with day trading is that there's no overnight risk. You have frequent trade setups and allows for daily profits and losses. Now the cons is going to be that it requires significant time commitment, emotionally intense and constant decision making, and you can tend to overtrade and chase moves or be a victim of FOMO whenever you're doing intraday trading. This is going to be best for traders who can dedicate full or part of their day to trading, those who prefer to avoid overnight exposure, and fast learners who enjoy rapid environments. So the next one is going to be swing trading. A lot of times swing trading and the last one, position trading, can be pretty much the same, but I'll go through both of them. So swing trading, you're going to be holding the trades for several days to weeks to catch swings or short to medium term trends. The time frame is going to be from days to weeks. The pros is that it requires less screen time than day trading, is ideal for those with a job or other responsibilities, and it capitalizes on meaningful market moves. The cons is that you're going to be exposed to overnight and weekend risk, requires patience and the ability to sit through pullbacks, and you're going to have fewer trade setups throughout the day or week. This is going to be best for people who can trade part-time, who want to trade part-time, and those who prefer a balanced lifestyle, and traders who are comfortable with holding through volatility. All right, now position trading is long-term trading approach based on fundamentals and macro trends. Trades last weeks, months, and even years. The time frame is weeks to months or longer, like I just mentioned. The pros, that there's minimal time commitment, lower stress, and fewer decisions. You capture big moves and long-term moves. You capture big long-term moves. Now the cons is that it's going to require large stop losses and patience. It's going to tie up your capital whenever you're in these trades. You can't use that money that's tied to that position to enter new positions. So that's one of the cons. And then market sentiment can change slowly. This is going to be best for investors or traders with strong fundamental or macro knowledge, those who want passive involvement, and people with long-term vision and discipline. Now, like I said, I like to do day trading. Day trading is all about entering and exiting positions within the same day. No overnight holds, no swing trades. The goal is small, consistent wins compounded over time. And to do that right, you need to choose the right market, the right instrument, and the right time frame. So I'm going to go into those next, and we'll talk about it a little bit more. So let's talk about the three main markets that day traders usually focus on. My favorite is futures. That's what I mainly trade. You can trade indices like the S&P 500, NASDAQ, the Dow, and many more. And there's no PDT rule. I'll get into the PDT rule when we talk about stocks and options. So now the next one is going to be forex. You're going to be trading currency pairs like the Euro USD or GBP, JPY. You have 24-hour access when you're trading forex throughout the week. and it closes at a certain time on Friday, but Monday through Thursday is technically 24 hours. So you can trade pretty much all day, but it does require precision. So the third one we have is stocks and options. It's great for volatility, but you need at least 25,000 to avoid the PDT rule in the USA. So the PDT rule is the pattern day trading rule. What that means is that within the US, they put this stipulation on people who have under $25,000 in an account that they can only place 4 trades within a 5-day trading week, right? So you can only place 4 trades a week if you have under $25,000. If you have over the $25,000, that'll allow you to avoid that PDT rule. And the main reason that they do that is because a lot of these brokers look at day traders as high risk trading. So they want you to have more money in your brokerage account before you can actually trade stocks and options. But that's why for beginners, forex and futures is pretty much the go-to. But futures is like the gentleman's club, and forex is like, I don't even know, like them 18 and up clubs. I don't even know how to explain it, but I think futures is just a little bit more regulated. Is US based in Chicago. A lot of these forex brokers are stationed like overseas whenever you're trading with them. So futures is just regulated in the US, and you don't have to really worry about your money just coming up missing sometimes. So I think that's the plus with futures. All right. And I told you, like, I love futures. I trade the NASDAQ, the S&P 500, mainly because of the clean structure and consistent movements that I get during the New York and London session. So that's why I stick to futures. Or indices. You could just say indices because you can trade forex. You could trade indices through a trusted forex broker, and I have one in the description below if you want to do that. With forex brokers, you're more than likely going to have to put up your own capital, but you can put as little as like $10 in there to get started, and you can trade micro lots. So when the NQ one contract is like, it's like 20,000 right now, but if you do it through a forex broker that allows you to do micro lots, you can purchase smaller sizes. All right, so now let's talk about time frames. So whenever you guys see me day trading, I'm always going to keep 3 time frames up. That's going to be my higher time frame, which is the 15-minute. Then I'll have a lower time frame, which is going to be my 5-minute, and then I'll have my execution time frame, which is going to be the 1-minute. For the 15-minute, I like to see my market structure, my key levels, and my bias. On the 5-minute, I'm looking for entries, confirmation, and precision. And then execution is all about execution. I'm just looking for my opportunity to get in the trade, to put me in a good position to minimize my risk. So all in all, you want to zoom out to see the big picture. So that's why we have that higher time frame. And then you want to zoom in to take precise trades. So that's why we go down to our execution time frame, our lower and our execution time frame, to get the right entry. All right. So the markets move differently during different sessions. These aren't all the sessions, but these are the sessions that I will want you guys to focus on. These are the sessions that I focus on most of the time, because you're going to get a great return on your trades. And it requires a lot less time to sit through the trades because of the volatility that's involved. You'll get more movement during these times. Okay. So we have the London Open, which is from 3 a.m. to 6 a.m. Eastern Standard Time. It's great for forex and futures. Then we have the New York Open, which is from 9:30 a.m. to 11:30 a.m. Eastern Standard Time, which is prime time for indices. So like I told you, I like to trade the S&P 500 and the NASDAQ. So that's my prime time right there. 9:30 a.m. is when I start looking for my trades. Then we have the lunch hour. I don't place any trades during the lunch hour. I look for my trade after 1:30. That's when I usually get a good setup for my after lunch trade, which then ties into the power hour trade, which you sometimes get the last surge, which is from 3 p.m. to 4 p.m. Eastern Standard Time. But a lot of times the lunch hour or the after lunch trade can be done before the power hour even starts. But depending on your bias and, your top down analysis, if your TP is, still hasn't been touched, you can still stay in your trades a lot of times through the power hour. All right, so most of my trades happen within the first 2 hours of the New York session. That's when volume, volatility, and opportunities are the highest, like I was mentioning. So I really focus on this New York Open because that's where I get some of the best trades. And you're done by 11:30 and you made somebody's monthly paycheck, or you know what I'm saying, in a couple hours. So that ain't bad. You never want to be too greedy when it comes to trading. All right, so the key takeaway is to pretty much just find your style. Like, this video is kind of to help you pinpoint your style, your personality, see the pros and cons, what your lifestyle is like. If you have the time to sit in front of the charts, if you don't, there's other styles of trading that kind of cater to that lifestyle, right? So the key takeaways from this video is pick one market to focus on. I recommend futures or indices through a trusted forex broker. You want to use multiple time frames to plan, confirm, and execute. And then you want to trade during the most active sessions because you don't want to be sitting in front of the charts all day. Most people get into trading not only because of how much money you can make, but and how little time it takes to make that money, where you can make, you know, a couple $1,000s in an hour, maybe even less, maybe a couple minutes. There's been times I've made thousands in a couple minutes. So it's just all about being there and being present and finding the right opportunity. All right. So like I told you, this video was real quick. We just wanted to go over the markets, instruments, and time frame. So if you're learning, just go ahead and smash that like button, subscribe, and hit that notification bell so you don't miss the next episode, where we're going to dive into market structure and price action, which I like to say is the real language of the markets. So if you found this video helpful, like I said, like and subscribe, and I'll catch you guys in episode 3.